Hey everyone, and welcome back to the AI Tech channel. Buckle up, because today we're diving into a potential tech war that could reshape the global AI landscape. The question on everyone's mind, is the US about to hand China a strategic victory in the AI race? Sounds crazy, right? Well, Microsoft thinks so, and they're not holding back. Leaked data suggests that if current AI export restrictions stay in place, China could surge ahead, dominating the next wave of AI innovation. This isn't just about tech. It's about global power, economic dominance, and the future of innovation. Are we about to witness a massive strategic misstep? Let's break it down. Microsoft is publicly pleading with President Trump to ease the export curbs on U.S. chips used in AI data centers. They're warning that these restrictions, originally put in place by the Biden administration, could backfire spectacularly, handing China a massive advantage. Brad Smith, Microsoft's vice chair and president, didn't mince words, calling it a potential strategic misstep in the high-stakes race to control the AI economy. Microsoft is worried that the current rules are hindering U.S. tech firms' ability to build and expand AI data centers in key strategic countries like Switzerland, Poland, Greece, Singapore, India, Israel, Indonesia, the UAE, and Saudi Arabia. These countries are crucial for the global AI ecosystem, and they're now potentially being pushed towards China. Let's rewind a bit. The Biden administration, right before leaving office, implemented rules restricting companies like NVIDIA and AMD from selling advanced GPUs to customers in China, Russia, Iran, and North Korea. This also forces cloud computing giants like Microsoft, Amazon, and Alphabet to jump through hoops to get special licenses for building data centers in countries with limited AI chip exports. The rationale was to prevent these countries from using U.S. technology for military or surveillance purposes. But Microsoft argues that the unintended consequence is crippling U.S. competitiveness. Customers in these countries are now worried about an insufficient supply of American AI technology, potentially restricting their economic growth. And guess who's ready to fill that void? You guessed it, China. Microsoft fears that if these rules remain unchanged, China will gain a strategic advantage in spreading its own AI technology to these countries and others. Think about it. China has been aggressively investing in its own AI capabilities for years, and now they have a golden opportunity to expand their influence globally. Microsoft is planning to spend a staggering $80 billion on building AI infrastructure around the world this year, with half of that investment right here in the US. But their ability to grow at this level depends on being able to export their services. The message from Microsoft to Trump is crystal clear. Eliminate the quantitative caps that would interfere with a well-functioning economic market. And keep what matters most, such as the qualitative security standards and AI use restrictions that protect national security. It's a delicate balance, but Microsoft believes it's crucial to get it right. This situation puts major tech companies in a tough spot. They're caught between national security concerns and the need to compete in the global market. On one hand, they want to protect their intellectual property and prevent their technology from being used for nefarious purposes. On the other hand, they need to access international markets to drive growth and innovation. The current restrictions are forcing them to make difficult choices, and they're worried about the long-term consequences. We're talking about billions of dollars in potential revenue, not to mention the risk of losing ground to Chinese competitors. So what does this mean for investors? Let's take a look at Microsoft. On tip ranks, Microsoft has a strong buy consensus based on 29 buy and 3 hold ratings. The highest price target is a whopping $600. While the consensus price target is $510.38, implying a potential upside of over 27%. This suggests that analysts are generally optimistic about Microsoft's future, despite the challenges posed by the AI export restrictions. However, it's important to remember that these price targets are based on certain assumptions, and any significant change in the regulatory landscape could impact the stock's performance. Keep an eye on how this situation unfolds, as it could present both opportunities and risks for Microsoft investors. Speaking of massive investments in AI infrastructure, Meta Platforms, the parent company of Facebook, is reportedly in talks with Apollo Global Management for a staggering $35 billion financing package to develop U.S. data centers. Meta plans to invest as much as $65 billion on AI-related projects this year, highlighting the massive capital expenditures required to stay competitive in the AI race. This move underscores the importance of data centers in powering AI models and the growing demand for computing power. It also shows that tech companies are willing to spend big to secure their position in the AI ecosystem. And let's not forget about NVIDIA, the king of AI chips. KeyBank Capital Markets expects NVIDIA to report strong quarterly results and guidance next week, despite facing challenges with its GB200 NVL servers. Five-star analyst John Vin anticipates that NVIDIA will beat consensus estimates and provide conservative guidance for the next quarter. He believes that manufacturing constraints on GB200 NVL server racks will be offset by other factors, such as customers switching to alternative products and a surge in demand for H20 GPUs from Chinese cloud service providers. This highlights the complex dynamics of the AI chip market and the factors that can influence NVIDIA's performance. NVIDIA's upcoming earnings report will be a key indicator of the overall health of the AI industry. Overall, analysts remain bullish on NVIDIA stock, with a strong buy consensus rating based on 35 buys and 3 holds assigned in the past 3 months. After a massive rally in its share price over the past year, the average NVIDIA price target of $178.83 per share implies an upside potential of over 30% from current levels. This reflects the widespread belief that NVIDIA will continue to be a major beneficiary of the AI boom. However, it's important to remember that NVIDIA's stock is highly valued, and any negative news or unexpected developments could trigger a significant correction. Now, let's zoom out and consider the broader geopolitical implications. The AI race is not just about technology. It's about power, influence, and national security. The country that dominates AI will have a significant advantage in areas such as defense, intelligence, and economic competitiveness. The US and China are locked in a fierce competition for AI supremacy, and the outcome will have profound consequences for the global balance of power. The AI export restrictions are just one piece of this complex puzzle, and the decisions made by the Trump administration will have a lasting impact on the future of AI development and deployment. So what's the bottom line? The AI export restrictions are a double-edged sword. While they may help to prevent certain countries from accessing U.S. technology for malicious purposes, they also risk hindering U.S. competitiveness and handing China a strategic advantage. The Trump administration needs to carefully weigh the potential benefits and risks before making any decisions. The future of AI is at stake, and the choices we make today will determine who leads the way in this transformative technology. What do you think? Should the U.S. ease the AI export restrictions? Let me know your thoughts in the comments below. And don't forget to like and subscribe for more in-depth analysis of the latest AI trends. Thanks for watching.